Oil long-term forecast for the week of January 2nd, FXEmpire.com. The light sweet crude market, as you see in front of you, had a flat end or a flat week as it ended basically unchanged over the last 5 sessions. You can see on the longer term charts, though, that the 105 level does look to be massive resistance. We have several different things going on in the long term right now that I will, of course, point out to you and just show you exactly at how much of a crossroads we are in the light sweet crude market. Number one, you can see that there is a downward channel that has been working. We've got lower highs and lower lows, classic technical analysis. We have resistance overhead at the 105 mark, so this makes sense. However, if we manage to break higher, you can make a case for a bull flag, which of course is very bullish. So having said all that, we now have two bullish scenarios or two bearish scenarios and one bullish scenario. Completely compounding this indecision, and I will change the color here, is the fact that a break higher would also be the completion of a W pattern, which lines up. On a W, you measure the height to the bottom. On a bull flag, you measure the height to the bottom on the pole. So either one of them would measure up to roughly the same picture. It should be about 132 and a half or so would be the target to the upside. However, as things continue on in the trading world, we can only assume that things will remain as they have been. So for the time being, the thesis that we are going with is that this downward channel should continue. The 105 should continue to be very repressive in its resistance. Of course, macroeconomic and headline risk can always step into the picture, but the odds are that the dollar is going to continue to strengthen through 2012, so it makes sense the oil would fall in that particular scenario. There's also the concerns of a slowdown in China and almost the definite slowdown coming in Europe, so demand for oil could continue to wane. Looking at the Brent markets, it's a much clearer picture in the sense that where you want to be. 112.50 to 102.50 has been the main price points basically that we've seen over most of the year. And because of this, we also see 107.50 as the midpoint, and that's exactly where we ended the week. The week did attempt to rise, but it fell, found some support at the end of the week on Thursday and Friday, and as such, we are staying out of this market, but we do want to buy at 102.50 and of course sell at 112.50. The first question that most traders will come up with is, well, how do I know when not to do this? And the answer is simple. It's when it stops working. We did recently have a head and shoulders break, complex head and shoulders. There is a question to be asked about that as well, but it appears in the bigger scheme of things, range-bound trading continues. If we break 102.50, then of course we think we head to the lows in 95.